In early 2020, the S&P 500 reached its highest point, but shortly after, it dropped by 34% due to the pandemic. Some investors wonder if they can make money by timing the market, trying to buy at the bottom and sell at the peak. However, studies show that timing the market is challenging and not a reliable strategy. One study from 2019 looked at a 10-year period from 2009 to 2018. If you invested $10,000 in the S&P 500 and stayed invested for the entire time, your money would have grown to $27,750, a 2.7x return. But if you missed just the 10 best days in that period, your return would have been only $17,220. Missing 30 of the best days would have caused you to lose money. This shows that staying invested for the long term and capturing the best market days is crucial for higher returns. The point is that we should invest for the long term and not let market volatility scare us into selling everything. Now, in the video, we will share how to build a strong portfolio for 2023, considering factors like rising interest rates, tighter monetary policy, and the possibility of recession. There's a lot of uncertainty in the market, especially with the Federal Reserve planning to increase interest rates through the first half of 2023. Signals a pause or stops raising rates. Next will be ETFs, which serve as the foundation of investments. ETFs typically offer an average return of about 7 to 10% per year. While the returns may vary each year, staying invested in ETFs over the long term can yield solid results. ETFs are like a one-stop shop for diversified investments. By buying an ETF, you gain exposure to a broad range of stocks or assets held within the fund. For example, investing in an S&P 500 tracking ETF gives you a small share in all the 511 stocks within that index. ETFs are like bundles of different stocks or assets, providing diversification and potential growth. For example, there's an ETF called VTI that covers the entire US stock market. The next part will consist of individual blue-chip stocks. These are large and stable companies like Google, IBM, Johnson & Johnson, Apple, and Amazon. Blue-chip stocks have a solid reputation, and they tend to be more reliable in the long term. We'll be looking at companies with a market capitalization of well over $100 billion. Avoiding penny stocks and meme stocks is essential, as they are often riskier and less stable. Instead, let's consider companies like American Express, AT&T, Salesforce, UPS, and McDonald's, among others. By diversifying my investments between ETFs and blue-chip stocks, we aim to capture growth opportunities while minimizing risks in my portfolio. For instance, Apple has seen substantial growth over the past 5 years, providing a good example of the potential upside for blue-chip stocks. Let's talk about how to pick stocks for your portfolio. We're going to divide it into different allocations to make it simpler. First, consider allocating 40% of your portfolio into ETFs. ETFs are like bundles of different stocks or assets, providing diversification and potential growth. They average around 7 to 10% return annually. Next, allocate 20% of your portfolio into individual blue-chip stocks. These are large, stable companies like Google, Apple, and more. Do your research on their balance sheet, earnings, and management team before investing. Keep 30% of your portfolio in cash. This is important because there's uncertainty in the market, especially with the Federal Reserve increasing interest rates. The remaining 10% of your portfolio is flexible and depends on your age and risk tolerance. If you're younger, consider investing in growth stocks, which have higher potential for returns. If you're older and seek more stability, consider investing in bonds. Remember, this is just a suggestion for those between 18 and 40 years old with a stable income. It's essential to do your own research and consider your risk tolerance when building your portfolio.